The skill is finding the company and convincing them to be sold at a lower price and then writing it and knowing when to sell it. The other side of it then is we've seen you buy it 10 times EBITDA and sell it 10 times EBITDA, but the earnings have grown dramatically.
Hey everyone, this is Prashant and I'll be your host for the VC 10X podcast, and today we have Justin Pollack with us. Justin is the Managing Director, Private Funds Group at PineBridge Investments. PineBridge Investments is a private equity firm managing over $150 billion in AUM. Justin is responsible for oversight of the global investment program of the Private Funds Group. In this episode, we talk about what is private equity, what are the different types of deals that private equity firms do, how different is private equity from venture capital, how do PE firms evaluate businesses, what are leveraged buyouts, how do private equity firms operate, portfolio construction approach at PE firms, and lots more. So without wasting any time, let's dive straight in. This episode is sponsored by my own podcasting agency called Podcast 10X, where I help VCs start and run their own podcast. While I was running VC 10X, this podcast that you're listening to right now, I asked my VC guests, why don't you start your own podcast? I mean, it's the best form of marketing for VCs. As they say, VC is a people play more than even a capital play. A podcast enables you to put your people at the front, your portfolio founders, your partners, and co-investors. It's a great way to build a brand and win competitive deals. It activates all your marketing channels in a single shot, be it YouTube or blog post or newsletter or social media. Everything gets activated in a single shot. And I get the same response from all the VCs that it's a lot of work and we don't have the time for it. I said, all right, let me handle the work for you, from pre-recording, editing, publishing to making social media clips. All you have to do is show up on a call, hit record, do the recording using the well-researched outline we provide you with, and you're done. We handle everything else. You know what they said? All right, let's give it a shot. So if you are a VC and want to up your marketing and branding game, I'd love to work with you. And if you're thinking there are too many VC podcasts already, remember there are way more VC firms out there. And if you're not standing out, you're losing out. So if you want to work with me on starting your podcast, go to podcast10x.com and book a call today. I'll add the link in the description and show notes below. Look forward to working with you. Hey, Justin, so good to have you on the VC 10X podcast. How are you doing?
I'm well. Thanks for having me.
Yeah, it's a pleasure having you on. And to start things off, can we first start with your background and what's your journey been in the investing landscape?
Sure. Well, happy to start. My career goes back to the late 90s. I'd started at an investment bank called Bear Stearns, which that is a very famous end, but at the time that I joined 98, was sort of a mid-sized investment bank. I was an analyst there, working on financial sponsor coverage in the investment bank, which meant working with a lot of the buyout firms, which back then were largely unknown. This was Blackstone and Apollo and Carlyle and a whole bunch of others. The private equity at that time was really, these were all small partnerships, firms that had 10 or 20 employees versus what you see now. Those same names are vastly larger. But we were helping them work on their acquisition and financing of positions, doing leverage buyouts. And that was a really nice entryway into the industry. A few years after that, I wound up moving over to a firm that's now known as HQ Capital. It's owned by or was at one point owned by the Harold Quant family, the BMW family out of Germany, but a business in New York investing in private equity. And I joined to help build out a piece of their broader program, which was the secondary market for private equity. So they had a long history of investing with buyout funds like Apollo and Blackstone and Carlyle and a few others. They saw an opportunity, not the first ones to see it, to invest into those funds several years into their life from investors who wanted to liquidate their positions in their private equity fund positions. And these were institutions who changed their minds, had mergers, had cash flow problems, and didn't want to continue to hold these illiquid investments that are very long dated. So we built up a team at HQ to just do secondaries. I was joined by a senior partner who had a lot of experience in this sort of nascent area. Had enough success doing that we eventually spun out and formed our own firm called Newbury Partners, where I was one of the founding partners. And that firm just focused on the secondary market. So what we saw early on, this was 2006, there was private equity was continuing to grow. So there's more private equity opportunities to buy into on a secondary basis, which is usually an institution makes an investment, and several years later, it could be 4, 6, 8, 10 years later, they haven't gotten full liquidity and want to sell out their position. This typically being a pool of assets with one manager, multiple company positions, lots of little bits of private companies. If you could find investors who had that, then you could talk to them about the idea, typically at the time of, hey, did you know you're allowed to sell your private equity investments? And the typical response was, no, I didn't know that. Tell me more. It allowed us to have a direct opportunity and a direct conversation, which was, well, if you're interested in selling, tell me what you own. We'll give you some prices. We can negotiate. If you like the prices, you'll sell something to us. And we're buying our own account, managing our own private equity funds that held these positions. The real pivot point came in the financial crisis that, of course, started with Bear Stearns, but eventually encompassed quite a few other companies globally, where all of a sudden we were in a liquidity crisis, and we at Newbury Partners were a liquidity provider, and so were a number of our peers. I think at the time, my metric is we've long had a dinner for secondary buyers, just an informal kind of thing, and it started probably over 20 years ago. There were 8 of us initially. I think by 2008, 2009, there were probably 20 of us representing 20 firms or something like that doing this kind of activity. But the demand was high and the values were questionable because everyone sort of viewed, if you own illiquid assets, it could all go bankrupt. All levered companies can go bankrupt. It's the end of the financial world. Of course, that didn't quite happen. But people may not remember is it took 6 months for the Federal Reserve to start printing money. And in that 6-month window, there really was a crisis every day where things got worse and worse and worse, and the stock market lower and lower over, day after day seemed more dark than the next. We bought a lot of assets at what we thought were very attractive prices. The market rebounded and it looked great in retrospect. What that led to was the secondary market for private equity. Quite a few investors identified it as, wow, this performed really well. It actually beat the performance of buyout funds. It suffered, generally speaking, as an industry, very few losses. It led to a pouring in of money starting in 2010 into this strategy with the idea of it seems pretty risk-adjusted, pretty attractive. The result of which was certainly we had more success at Newbury Partners, but we saw a lot of new competitors form as well with the idea of, gee, this is so good, I should get into it, including a number of groups that sold assets to us. The lesson they took from that was they wanted to be a buyer, not a seller. And that eventually led to a significant growth in the marketplace. After 13 years with the Newbury team, I eventually decided to take my leave. I joined the group that I'm with now, PineBridge Investments, where I'm a managing director, overseeing and working on the same strategy that I've been doing this entire time for over 20 years of secondary investing. And PineBridge, the difference is it's a global asset manager, about $150 billion of assets under management across equity, fixed income, multi-asset, and then alternatives, including the private equity secondaries. My team covers, or I should say is based in 6 countries. So we're headquartered here in New York, but I have colleagues in Mexico City, London, Zurich, Hong Kong, and Mumbai. We're able to cover the world of private equity locally. My team speaks 12 languages natively. It's a very different construct for covering the market. And the reason I was really attracted to that, and the secondary market's still quite vibrant, and we can talk about how it's changed. But the one thing that hasn't really changed over all this time is anytime there's many more competitors. So my reference point of that dinner that we now have has over 100 people at it, 100 plus firms, a lot more groups doing it. But one thing that hasn't changed though is while there's a vibrant secondary market, there's no marketplace. If you're an investor, whether an individual or an institution, and you want to sell private equity, you cannot go to a website and type in the name of your fund and say, how much is it worth? You can't go to a clearinghouse and try to find bidders. There's no real alternative. There's no stock market type equivalent. You have to still individually negotiate. You can hire a broker, an investment banker to help you sell it, but it's still a one-on-one negotiation ultimately because this element of private equity is still very private. And That's why I felt having the capabilities to have global reach and see a lot of interesting opportunities makes secondary markets still an interesting place to play, provided you have the right outreach, the right due diligence capabilities. But it's been amazing to me over what's now been 24 years of working on secondaries, how much the whole market's grown. The last thing I'd say is it's still derivative of private equity has grown just as much because this is derivative. Private equity has grown something on the order of a 15% compound annual growth rate since 2000, which for any industry would be sort of unbelievable, to say nothing of something in finance that's gotten this large. So when I started, it was maybe a $500 billion of assets under management across private equity. Now it's something closer to $10 trillion. I don't know what the future holds, but the industry is now much wider, much deeper, has lots of different flavors to it, and that affects secondaries because there's a lot more flavors of secondary activity.
Absolutely. That's an amazing insight into what you do and sort of the evolution of the private equity world itself. And you've had the experience of working at some of the best private equity funds or names out there today. So what do you think has changed from when the industry started up until now, and how things operate within private equity, and what was the focus of private equity funds back then and what it has evolved into as of now?
Yeah, the size makes a very significant difference. So again, when I talk about the origins, and as even in the late 90s, when I was on an investment banking team proposing opportunities or working with a financial sponsor, it was pretty common if we were talking to Blackstone, Steve Schwartzman, when it was there, maybe Pete Peterson, the two founders, were in the meeting. The same thing was true if we're talking to Apollo. Leon Black was in the meeting, because the whole firm was small, and if we're doing something important, they kind of wanted to sit and listen. It was very much a cottage industry. It was much smaller. There were fewer bankers, fewer banks that provided this kind of debt, and so on. Today, all those people I named and many others similar who are founders of firms are CEOs, to the extent they're still working, are CEOs of giant businesses that don't have 15 employees, they have 1,500. The scale is very different. Their capabilities are much broader as well. But in parallel to that, I think private equity has really proven itself through performance. And what the core of buyouts, really starting from the early origin in the late 70s and into the late 80s, was find a company, whether it's public or private, professionalize it, get rid of a lot of low-hanging fruit of cost. You had executives who were flying on private jets, and not spending much time actually working. And you had country club memberships and all these kinds of things, to say nothing of antiquated manufacturing techniques and all those kinds of things. Private equity would come in, and it was revelation years ago, telling a company, have you heard of Six Sigma or Lean? We're going to change how you manufacture. Those things were sort of mind-blowing. Now, I think a lot of companies, particularly those in the public market, already do those things. They've already adopted a lot of the things from the levered buyout playbook of otherwise activist hedge funds and others are going to try to force them to. There's more, that professionalization kind of gave competition across the broader market for owning assets, so that everyone's doing it. So if you're a buyout fund going into a company now, particularly on the larger end, the opportunities are different in terms of the old playbook doesn't quite work the same way because people have already adopted it themselves, even if there wasn't a private equity owner. In the same way that private equity has been very experienced in trying to drive operational improvements and hire the right consultants to help operations. Well, a lot of companies now will just, they can hire consultants on their own for the same reason, just to kind of professionalize things to improve their businesses. The one area that's not quite as true is as you get smaller, the middle market, the lower middle markets, these are businesses that are below $100 million EBITDA, often below $50 million EBITDA, enterprise value below $1 billion. Smaller businesses just don't have the same capitalization to be able to afford to do those kinds of things. They don't have the same types of management to the extent they have more than one or two real serious managers. And that's what we've seen in private equity, is that's where the old style playbooks still going to work. And it's not that, for example, if you buy a smaller private business with a founder still running it and has for 30 years doing some kind of manufacturing, it's not that owner necessarily hasn't heard of lean manufacturing or Six Sigma. It's just like I don't have the time to implement it. I wouldn't know the first thing about it. I've heard about it, but it's a daily struggle. The idea behind private equity is you come in and more fully capitalize a business and then give more support to help them kind of achieve strategic objectives over several years. I think that continues. The key there is those firms that are doing that type of work in the middle market tend to be back to what we saw. These are 10 and 20 person shops that, there's more direction from the very top, kind of putting their fingers in things. So in some ways, the buyout world hasn't changed. It's just gotten much larger, and the smaller end stays the same. The larger end still has lots of positive attributes, but they're much more vast asset managers of their own right in terms of how they're building portfolios, trying to balance opportunities. It's a different kind of business now, but as a whole, the roots of private equity remain the same. I'd say the one thing that washes over all of it is there's more competition. So if I've said there's over 100 secondary buyers, there's many thousands of leveraged buyout funds now, whereas years ago there were literally just a handful. And years ago, before I started my career. So that level of competition starts affecting, the prices that you'll pay for things, how much opportunity is available. There's less undiscovered country in terms of lots of buyout funds have calling programs trying to identify great companies. And then lastly, there's a lot more infrastructure around the whole industry. There's many more bankers and lawyers and accountants, so that if you are a owner of a private business, as an extreme example, even one with $5 million of EBITDA, the odds that a private equity fund can come approach you and say, you've probably never heard of private equity before, but let me tell you a story. You as the owner would cut them off and be like, oh, no, I've heard from 15 other groups already this month. And I have my own investment banker, and my lawyer has done deals like this before. It just, that there's more transparency in some ways, which I think is generally good. But there's no secrets. And that's the flip side, is you can't make the arbitrage opportunity of simply buying stuff because it's private or lesser known. That doesn't quite exist anymore.
Absolutely. That's very interesting to learn. And talking about the mindset of private equity investors, so since at the podcast, we mostly talk to VCs, we know what their mindset is. They are mostly looking for moonshots, which are going to either make it or fail, but the ones that make it cover up for all the other investments. So can you help me differentiate how do private equity, who are coming somewhat at a later stage, what's their mindset and what are their motivations? How do they look at a business differently than venture capitalists? What are they looking for in a business, basically?
Yeah, it's that the risk profile is definitely different. I think that moonshot is the good example where if you look at literal moonshots in the last 10 years, countries and private businesses trying to get to the moon, virtually all of them have failed in one way or the other. And again, this includes country programs, but also private ones. I think that's what we see in a lot of VC is there's a vast failure, even though they can be innovative with technology, do interesting things. They don't achieve their objective of making giant returns. The contrast is in private equity. The goal is something far less than that. Just trying to achieve flight. There's a lot of operators of private planes and all kinds of vehicles that can get you in the air, not into orbit, but into the air. That's probably closer to what we're seeing. There's a lot of different sports analogies of, in some way, trying to do much more modest type of generation of returns. The types of businesses they're buying in the leveraged buyout world tend to be more mature with products that are more stable, with high cash flow, and that cash flow allows you to buy the business using some form of meaningful debt, which is where the leveraged buyout comes into place. But the opportunity set is very different, usually in much more competitive industries. So then there's a question, are you buying an industry leader? Or are you buying someone that's behind for some reason that you can fix? What's the growth opportunity? Because if it's a competitive environment, you're going to max out your price, you're going to max out your leverage to try to achieve that maximum price. As a buyout fund, you see an opportunity to introduce new products or improve the, cut costs or enter a new geography. These are all basic business principles for a growing business. The key is you really can't do all of them at once. You can't think you're going to lay off 20% of your staff and introduce new products and all of a sudden move a U.S. business into Europe. Like that doesn't all work together. I think that's one of the things that people misunderstand about buyouts. It tends to get a lot of headlines when there's layoffs or other kinds of things going on, which can be very healthy for a business, but that's usually not a positive sign for growth. It's usually when something has gone less well than hoped for, because the best buyout businesses have growth in a variety of forms. They may be more efficiently run, but it's tagged along with that growth. And then it leads to outcomes where they're getting, if venture capital funds are trying to return, if they're investing in 20, 30, 40 companies across a fund, they want one of those companies to, in exit, cover all the costs of the entire portfolio and then hoping for more profits beyond that. Buyouts are much more modest in terms of their expectations. Typically in underwriting is, I wouldn't say specifically how much level of return, but they're trying to beat the public markets over a long period of time is a general idea. And if the public markets, and I'd say less the S&P 500 because that's large cap, but if you go into the Russell 2000 and a variety of other indices that are mid-market to smaller market, see how they're performing. You're buying similar businesses. If you are buying them better, either you're buying them at a better price or you're picking out the best ones and helping them improve outside the spotlight of the public market, you should be beating the public market. And that's what a lot of limited partners are looking for from buyouts, is an enhancement to their public equity returns over a long period of time, not necessarily over 1 year or even 3 years, but the 5 and 10 and 15-year type returns, which we have seen buyouts deliver as a meaningful step up to what public equity is delivering.
Absolutely. And we have probably mentioned buyout funds a lot of times in this conversation. So what are the different kinds of deals that happen within private equity? Is buyout one particular kind of deal that happens, and what that really is in simple words? And what are the other kinds of deals that private equity does?
Yeah, so I'd say, and private equity for me is any ownership within equity in any private business, including venture capital. Some of these things are synonyms and sometimes they're used differently. That said, the area we tend to spend more time on, the private equity segment that's more within the buyout space. And we sort of divide it up with, there's a handful of very basic strategies. The first in the origins of buyouts where you lever up the business. So you convince the seller to sell to you, and then you borrow half or more of the equity, the money that you're going to pay them with from a bank, from bondholders or something similar. And that's still a key component to a lot of what we see in leveraged buyouts. The argument, though, is where that used to find there was a great triage between the interest rate and the fact that the seller there wasn't much competition. It's like, take my offer or you're not selling. Now that equivalent would be take my offer, and if you don't, you'll sell to one of 10 other buyout funds who've given you an offer. So it's going to push up the price. What that leads to is other variations of strategy. That might be a core, but there's, I'd say one major area is carving out, where you're taking a business in some form that's embedded in another one, oftentimes a public company that has multiple divisions, where you can, when it's given its own attention, it may be an orphan inside of a larger company because they just don't have the resources. They have lots of management, lots of opinions, but no focus on that particular division. There's a good case to be made that separating a business out from ownership that was neglecting it could be very, very, very useful if you can find the right management, whether in there already or you have to bring in new management, but you also have to build a whole infrastructure around it, because when you take it outside of a conglomerate, you lose the HR, the accounting, and a lot of other the finance. You have to build a whole business, the infrastructure around it. We see a lot of, I'd say, cleanup type trades. You're finding a business that has some operational problems, which tends to go against the idea of lever up. Lenders are less interested in the business that has operational problems. But we see a lot of buyout funds that argue they have the requisite skills and people on staff to be able to come in and fix manufacturing problems, supply chain problems, it could be HR problems, anything across the operations of the business that are not quick fixes either. It may take more money. You have old machines. It may take time. If you're going to, you have to recruit new people in, you have to train them properly. It can take both those things together, which require a lot of patience to know that your investment's going to pay off eventually. It can take resetting customer or supplier views of that business. We don't want to that's a damaged business. I don't want to supply it. I'm a customer. I don't trust them anymore. You have to reset the whole narrative So that what I call cleanup trades are pretty prevalent. And then there's also a whole sphere of, in some way, working with management, whether it's a private business or otherwise, of buying out the business, and we public too, with the presumption that management had things they wanted to do that they weren't allowed to because there's a private owner who wouldn't let them or wouldn't capitalize it the way they wanted. It's publicly traded, and the shareholders were in some ways, limiting their opportunity. And if you can go take that business, change the ownership, remove it from the public glare, but keep the management, which arguably should know their whole business and will articulate they're running it properly, but they've had constraints, how to leverage buyout fund can come in and solve for, that becomes very interesting. And that across all of that, this spans all industries, all geographies. From a stage of business, we'd sort of consider venture capital to be things where they haven't yet reached revenue break even, cash flow break even. That tends to be venture capital. Venture capital also tends to have where the products are more nascent and you don't know exactly who's going to use them, or technology is unproven. As you get further into that, there's variations. People would say growth equity, but if you have a cash flow generative business, you can add leverage. You can do a leverage buyout in some fashion. Then just a question of what across that matrix you're doing for it. But the other end is eventually you reach a point for the maturity of any business where it's so old that it's declining. Again, whether there's operational problems or bad balance sheet financial problems, or it's just in an industry that's in decline, where there's a question of whether or not you can do something to either as turn it around, which can be very interesting. You can fix some operational problems, get it ready for selling into what's more modernized products and so on. And that's true of some industries, but others, it's how can you help it? How can you maximize cash for a completely dying industry? And I'd use the example we've seen over the years. We saw one business that was leasing out televisions in the UK, for example, which was something the BBC did a long time ago. Now you can obviously buy a television for a much more modest price than you could 20, 30, 40 years ago, but there are still mostly elderly people leasing their televisions. And the very strict math was the customer base, as it died, the revenue base went with it because no one was leasing televisions anymore. That was a business, as an extreme example, is how much money can you make before the business reaches zero? And there's a place for private equity on that as well, because if you view it with all due respect to the people who are the leasers who, aren't long for this world, it's just a cash flow stream. And to me, this all gets back to what's finance. Is every business we're looking at is viewed as just a cash flow stream. How certain is it? How stable is it? And how predictable? That starts influencing where does it sit on the spectrum of private equity or venture capital or distress and turnaround or similar strategies.
Absolutely. That's very interesting. And so you mentioned how sometimes a business can go through a rough phase where that industry might be going to die in some years or might not be relevant in some years. That can happen with the example you shared about television, that it became more affordable and everyone could afford it. So leasing it didn't make sense. A similar thing applied to today might be artificial intelligence, right? Artificial intelligence, some people say, can render a lot of software businesses obsolete, that people are going to just use AI and build that software in-house, and then the business who was in a way leasing their software to other companies and taking payments for it, that would become irrelevant. How does private equity look at that? Do you think that is going to happen, that artificial intelligence might be the reason for the death of a lot of these software businesses? Or do you think that, no, that's not going to happen? So any kind of deals that are happening because of that reason?
Yeah, well, I'd say that the first thing we've seen in the last couple of years is AI being used across our entire portfolio. All industries, big companies, small companies. In some ways, we use it here at PineBridge, but Microsoft for $20 a month, you can utilize their software. And mostly what you're doing, it's really more machine learning. It's summarizing notes. It's not doing next level kind of computing. It's saving, it's an efficiency tool for us. And it's been an efficiency tool for a lot of the companies that we've seen in our portfolio. They're doing, they're using it to save some administrative time. there's other functionality that starts building in further, but it hasn't yet. We see a lot of companies that are not software businesses on their own, but are doing other things, deciding it's not worth the investment cost yet, when things are clearly going to become turnkey, where you just pay a subscription to Microsoft or whomever else to get this level of functionality. We have plenty of software businesses, though, in our portfolio, high cash flow businesses, stable revenue base, easy to lever. So good businesses to be in the leveraged buyout world, where there are questions as to what are you doing that won't be disintermediated by AI in particular, because they're on the sort of the tipping point of where things that could be more easily done, because it doesn't involve people to begin with. It's all software driven. And I think each of them have their own rationale for why they'll be okay, or why they're specialized, or frankly, why AI is going to be one more cost that's layered on a business and you don't get rid of the existing. And that's what we're seeing right now is the administrative help is freeing up us from more time. So perhaps everyone can do a little bit more. It's great. The argument we're seeing from those who are a little further along is you're not going to be able to get rid of your, super technical accounting software or the stuff that runs your manufacturing equipment. You're just going to have a layer on top of it that makes it more efficient, and that's going to cost you even more money. So it may make you more efficient, but it's not going to save you money on software costs. We'll see. I mean, it's one of the things we're monitoring. Our view is, as fast as the changes happen, as much as we've seen companies who 2 years ago were telling us that AI was not for their industry, who are now embracing it, it's still at a very nascent level. It's still very early, and it hasn't been so vastly productive that it's made any significant difference. But it certainly has been helpful in terms of saving some time, a little bit of money, and mostly shifting people into eliminating the things they least want to do that are the most administrative. We'll see what's to come beyond that.
Absolutely. Thanks for sharing your views on that. And talking about the exit pathways and the life cycle of a private equity fund, right? So tell us more about that. We know that venture capital is 10 years cycle. Is it like similar for private equity funds as well? And what are the potential exit pathways? How do they get exit and liquidity into the fund?
Yeah, the structure generically is often the same. 10-year term for buyout funds, similar to most venture capital funds. And there's variations, but I'd say, the vast majority of all funds and similar strategies follow that rule, just because that's the way it's always been done. There's no other strong reason. The rationale in buyouts, though, is you'll typically see a 5 or 6 year window to make investments, identify the companies you're going to invest in. And in theory, you're supposed to sell all of them within 10 years. However, most funds actually have a couple of years of automatic extension. So they're really 12-year vehicles. The fund manager can automatically extend it. So saying 10 is kind of a misnomer when they're really automatically 12. And then speaking as someone who's focused on secondaries, well, we are often looking at older funds that someone's saying, I thought I'd have more liquidity by now, or I wanted more, I didn't get it. Would you buy my fund? It doesn't stop with funds that are 8 or 10 or 12 years old. We see funds that are 15 years old, 20 years old, and still have something remaining in their portfolio. There's nothing stopping that, because the key for a fund manager and for their limited partners is if you don't want to, at some point the investors have to approve continuing the idea of that extension. The fund manager can simply say, well, if you don't like it, I'll give you the private shares in this private company. You operate the business, which of course no one's set up to do. So you're kind of stuck. And this kind of, one of the things we've found speaking to buyouts is the average holding period. Historically, and to this day, most funds will talk about, well, we try to hold things 3 to 5 years. So say an average of 4 years, which if you line that up with, say, a 6-year investment period and a 10-year term, if you make an investment in year 6, that's your last investment, it will be exited on average by year 10, the end of your term, and done, perfect. The reality is the average holding period for buyouts hasn't been 4 years since I've been working in this industry, 2.5 decades. So it's sort of wishful thinking. The average holding typically is 5 years plus, and it varies by economic cycle. So during more difficult times, the periods get elongated, not significantly, but to 6 years, a little bit beyond. So fundamentally, if you're doing investments in year 6, the likelihood is you're not going to get out until year 11 on average. And that's what starts letting you have much longer tails to that as well. I think most investors understand that this is an asset class where if you can clear most of your, it's always an 80-20 rule. If you can get most of 80% of your profits from 20% of those investments and get clear them into 10 years, whatever comes after that is going to be even more profit. So you're a little less annoyed by that tail piece. But this is fundamentally the issue with private investments across the whole investment spectrum of investing is they're hard to trade. Fund managers who invest their own money want to maximize value. There's no incentive to sell low, but no one knows exactly what that value is because there's no easy reference public purchase price in the stock market kind of thing. So you want to wait, you want to maximize value. That's economically rational. That's performing a fiduciary duty. But what happens if that maximization takes 3 more years? That's the tension. That's what leads to the secondary market being vibrant is investors who, I don't say cut their losses, they cut their gains. And they'll say, I've already made a lot of money on this position. I could potentially make more, but I want to recycle into something more exciting, something newer. And that's why we see a lot of trades of older positions. And I think that's as private equity continues to grow, we'll just continue to see more and more secondaries because ultimately trading financial assets is pretty typical. All kinds of institutions do that across stocks and bonds and all kinds of other things, collateralized loan obligations and other kinds of more esoteric securities. Private equity on the day is still just you're trading securities via a secondary. It's just more challenging to do because of that lack of marketplace.
Absolutely. That's a very interesting point there that they're not cutting their losses, they're cutting their gains. Talking about the secondary market, right? You mentioned there is no market for it as such, right? Somewhat similar to venture capital, there's no market for it. But then how do you find quality deals? What's the sourcing mechanism for private equity firms?
Yeah, and speaking for, and this is true across private equity, whether you're focusing on secondary opportunities or you're a buyout firm directly trying to find opportunities to invest in companies. What used to exist, and by that I mean 20 years ago, or what you kind of generalized, maybe it was 15, there was more opportunities, arguably, to go directly to a company, directly to an investor institution who has private equity, in some way tell a founder of a business, hey, would you be interested in selling or working with me? Tell an insurance company, a bank who owns private equity interests, would you be interested in selling them? Let's talk about what money you could make from this. Most of that is gone, I'd say, because the whole private equity institutionalized in a way where there's now investment bankers or brokers, whatever they might want to call themselves, who will intermediate no matter what you're selling, whether obviously a giant business or a giant portfolio of assets that's billions of dollars. If you make a mistake as a seller, even if you think you want to do it yourself, a 1% mistake can be an 8-figure mistake in terms of dollar value. You'd rather pay something to an investment banker to make sure the value is maximized and you can demonstrate they called lots of buyers and narrowed it down to the highest price. That's always been true, but now it's also true as when you have a tiny portfolio or a tiny business, there's going to be someone who's interested in helping to intermediate it. And the reason is it's much easier now for that broker, that investment banker, to find buyers. Because, I started my career, there certainly was email, but no people weren't using it the same way now. You had to call someone on the phone, leave them a voicemail, hope they call you back. It was a little more dogged in terms of trying to get someone to say, are you interested in buying this? I'm representing a seller. I think that the change now, it's vastly easier to send a note to 10, 50, 100 potential buyers. I'm representing a seller. They have these assets. If you're interested, send me a note back. And then if you get to that next stage, it used to be, again, I'm looking back quite a distance, what due diligence materials do you have? Like, well, in the lawyer's office, we have this room filled with paper. You can send someone over and physically photocopy every piece of financial statements, all kinds of consultant reports, what have you. You can physically do that and then go read them. Well, now you can click a button and you get PDFs of all that material 10 seconds later. It leads into where we're heading, of course, is, as you had mentioned earlier, maybe AI will be able to scan that whole data room for you and summarize the entire, 500 documents in 10 seconds and give you a quick readout. As that efficiency gains, my view is the benefit is the market becomes more efficient, and presumably the sellers gain the benefit of that. You're squeezing out the inefficiency which tended to benefit the buyers. The last piece, though, is the market. The market's more efficient. Any seller knows how they can easily hire someone to, in theory, get them the highest price. The real issue, though, becomes, again, whether you're buying a company or a portfolio of investments, there's so much competition that as a buyer, the way we look at things, I don't want to waste my time. I don't have, these are still bespoke opportunities. It's not like I have a standardized model on what we, as equity traders might have for, well, what price do I like Google at? What price do I like Facebook at? And when the stock price hits that, I'm a buyer or seller based on my model. And that can happen 100 times a day. Like I have a computer assist me. We may see an opportunity of a certain portfolio or a company, once, period. And there might be similar ones, but that specific opportunity once. So we have to do a lot of modeling and investigation immediately. We don't want to waste our time, nor do our peers. So there's the inefficiency is, how do I know when you're selling a bespoke asset? Number one, you're really going to sell it. Like your expectations aren't too high in price. And then number two, how do I'm worried that if you invite 100 people into the process, just generically, I think my chances are 1%, assuming everyone's kind of equal weighted, like not really worth my time. I want my 10% chance or 20% chance. And that's where it starts becoming, as a professional, can you read the situation properly? Have you had any advanced talks perhaps with the seller, even though they know representative, but you kind of know that like they're realistic or not? Beyond that, do you have a better view on the assets where you think that even if you are the highest price, you still love the asset enough that it's going to be the right price because you have a different view on other people? Those are the elements. And this is typical for all of finance, for all of investing. But that's where private equity, it's a little more obscured because you don't really know when you're walking in the door where the pricing is versus the public markets. You don't know the likelihood of a seller, whereas public markets are really representing many sellers all at once. That's the trick. To me, at the end of the day, for us, beyond not wasting our capitals, we don't want to waste our time.
Certainly, that's very interesting about the dynamics of investing into private assets. And like you said, very different from public markets. You can only see an opportunity once, and then you have to evaluate read the room, basically, on how it feels like to get into this deal. What's the competition there? What could be the valuation? Are the expectation realistic or not? But keeping that aside, about evaluating the deal itself, the business itself, right? What are the key things on that front? And I believe you also indulge in secondary transactions of entire portfolios as well, not just singular assets.
Yeah.
So tell me more about that. Yeah.
Sure. Yeah. The core is the same, whether you're buying an individual business or a position in a private equity fund that owns 10 businesses, or a portfolio of 10 funds that each own 10 businesses. So now you're buying pieces of 100 businesses. It's number one, looking at its financial strength, its balance sheet. These are all like finance 101, accounting 101 type stuff. Looking at how levered is it? You start looking at how, what is it cash flow positive or not? What's the valuation on an EBITDA basis of it? So what are you paying for all that cash flow? You can start getting into on the balance sheet, looking at turnover in terms of payables and receivables. And these are all standardized type metrics. There's nothing really, depends on the industry, but nothing really hidden in that. You're trying to then also compare it against its peers in the industry. It's very easy to look at publicly traded comparable companies and say, they're in a business where they're have lots of customers who pay on 60-day windows. And all of your peers are getting paid, and the average turnover of receivables is 59 days. You're at 70. Like, how come people aren't paying their bills to you on an exaggerated basis? A lot of stuff on that side. The same is true in operations. They're trying to assess the efficiency of its business, just structurally, the marketing team, who's delivering product, how are you innovating? Which there's questions of how many engineers do you have? How many salespeople? These are all simple things to kind of fill out on a form in a sense. None of these are revelatory ideas from a business due diligence standpoint. You go through all the operations in that way. If you're buying a company directly, you can spend a lot more time on it, talking to management, talking about the future plans. Frankly, spend months researching everything in endless detail. And you can look at inventory turnover, but you're not looking at one stat, what's the inventory turnover last quarter, last year, but every individual SKU in the product mix. And for some businesses, if they're selling a consumer product, they have 1,000 SKUs. It's why did this t-shirt that was red sell really well, and this t-shirt that's identical but it's blue sell nothing? You're getting into super level detail. As you get closer in, the more you're aggregating things together, so you're buying a fund position with 10 companies, it starts relying more upon talking to the general partner, to the fund manager, talk me through the company and really identify what are the major issues for this business. I'm not going to spend all my time. It's inventory turn is not an issue. I'm not going to spend a lot of time talking about it, because they can in a sentence say the industry average inventory turn is 30 days and we're at 29. Like, okay, check, next question. There's no need to delve into detail of, well, it's 20 for the blue t-shirts and it's 50 for the red ones or what have you. It just there's not enough time to spend on that. As an aggregate, the business is performing well on that measure, but they have a big issue with personnel turnover or something like that. Well, how are you going to fix that problem? You keep losing employees. That's where you start directing your attention, as well as what's common to both of those. You also think, how do you get out of this? Who's going to want to buy it? Where is this heading? And that's, pretty telling. If you're looking at an individual company, you really can't ask. It's less about what does management think, because if you're the buyer, you have to have a perspective on the industry. You have a view of this is going to be attractive. There's really only a few ways out. Number one is you can do an initial public offering, but if you look at the sell your shares in the IPO and then perhaps in a secondary offering subsequently, and the public market hopefully fully values it, and that's clearly the market price, because you have potentially thousands of investors telling you that's the price. IPOs, certainly in the U.S., by number, are down significantly in the last 20 years. So that's becoming less and less of an option. And it's for bigger and bigger companies for the most part, in part because they can't find anybody else to own them. And it's easier to break that ownership up into thousands of pieces than it is to sell to one group. So if the IPO opportunity is smaller, the other kind of key exits, number one is you sell to a strategic buyer. You find another player in the same industry or an adjacent industry who might want to buy the business and take it on. And then it's a question of, are they buying it because it's high growth? Are they buying it because it's high cash flow? Are they buying it because it's in a geography they don't cover? It has customers they don't cover. In what way is it the same and in what way is it different? That a strategic acquirer, hopefully multiple, are going to want to buy it, with the notion that that strategic buyer is going to pay a premium because they have synergies they can add. They can bring the business on and, frankly, lay off a whole bunch of people, close factories, consolidate, and save a lot of money putting those operations together, making them more efficient. That leaves the third domain of sell to another financial buyer, another buyout firm or similar, who doesn't have, certainly doesn't have those efficiencies there because they're just going to substitute ownership. And then it's a question of, are they really, they are more likely to be a lower bid type buyer because they don't have, you don't get public market efficiency of ownership, maximizing value. You don't have synergies to potentially maximize value. You just have another financial buyer's opinion of how they can maximize the business in a way that perhaps you haven't yet as the seller. There's vast numbers of sales going on for sure, and that's a key component of sales, particularly on the larger end of the market, which have long relied upon IPOs, which again are dwindling in number, where it's very hard to sell a $5 billion business. And how many strategic acquirers can buy a $5 billion business? Oddly enough, there's quite a few buyers, financial buyers, who with leverage can buy that business. So you're really just rotating and selling to a peer. That's not bad. It's just moving things around in a way. And you have to present to them the reason why they're going to want to buy it. Okay, we did these wonderful things for the last 5 years, and we introduced a new product, and we opened up in Europe. The next 5 years, the reason you, the new buyer, want to buy it is because you can save money over here, or you can open up in Asia. You have to pass along the investment rationale almost to them to be able to achieve that exit. So that said, that's common across private equity. For us, if you're buying an individual business, you better have a very specific view of who you might want to sell it to and what milestones are going to unlock that opportunity. When we hit a certain EBITDA, when we hit a certain product volume, we have a certain number of customers, these groups are going to be interested. When you start moving into, as a secondary buyer, buying a portfolio at one fund with 10 companies, it's a little more surface level of trying to understand which one, we understand the company, which ones are good or bad. Out of 10, there might be good and bad. Which ones are also more likely to exit now versus wind up in this, we talked about a very long holding period. Which ones are more likely to wind up not getting exits for a long time because their business milestones are very far out in terms of time. One more layer removed is if you're buying a portfolio of multiple funds that own lots of companies, you're still doing all of that, but in much more summary fashion, because there's not enough time to delve in, nor is there a lot of value in, we've figured out that, the future behind one company, which represents 1/10 of 1% of the portfolio, is not super valuable unless you can do it across, all of the 100 or 1,000 companies. And that's where, as a secondary buyer, our expertise is having the ability to form very quick views on companies and the industry, and very quickly be able to ask a general partner, that fund sponsor, the questions they don't want us to ask. So we're not going to say, how is business for this company? Because we don't have that much time to talk about each company. But we can say, we know you're a manufacturer of textiles and T-shirts. We know the industry has been hit by the following 3 issues lately because we have 3 more businesses just like it in our portfolio. How are you different? And if you're not different, how are you dealing with this challenge? And we've always found as fund managers that, they'll rarely ever lie to you, but they'll certainly focus on the best things, not the worst. You have to bring out the worst and make them explain how they're dealing with those challenges and how it's going to lead them to a hopefully profitable exit. And we find that's the key for us, is you have to come in knowing what answers you're seeking, rather than hoping people will kind of just explain to you what's good and bad and what's going on, because there's not enough time for that. And it's not going to reveal itself unless you're correctly inquisitive.
Right. Yeah, that's very insightful. And you're wasting no time at all. You're just getting to, okay, I want to know the bad, the ugly, and that first. And I know what's good about you, sort of. And then, so there are 2 parts of the business when it comes to private equity. One is like picking and making the investments, and the other is kind of building those businesses further and, sort of growing them. So what do you think has been the primary reason for the most successful private equity firms of today? Was it the picking part and investing part, or was it that they did well with that business after they have invested and grown it, and then exited that business? What do you think is more important here?
Yeah, no, we certainly have. We've done a lot of work ourselves to figure out, is it the entry and picking right, or is it the operations thereafter? And the answer is it's both, or sometimes it's the extreme of one or extreme of the other. And you can see that with, if you bought something for 6 times EBITDA and sold it for 10 times, as a generic example, well, then you bought right, probably, because you got to use multiple expansion. And private equity has been funded by a lot of multiple expansion in the last 15 years, since the financial crisis, but so has the public market. All public companies are trading at higher earnings today than they were 15 years ago, and it's been a long, steady state. And you can say whether that's good or bad, but that's not skill. That's going to give it to you. But the skill is finding the company and convincing them to be sold at a lower price, and then riding it and knowing when to sell it. The other side of it then is, we've seen you buy it 10 times EBITDA and sell it 10 times EBITDA, but the earnings have grown dramatically. We're always looking at how much earnings growth has there been in that period of time, and then why did the earnings grow. You can compare the earnings growth of a certain company to the industry that it's in, and these are easy to find kind of pieces of information. And if you're in healthcare services, which have been growing at rates above the broader economy, even though it's a core industry of the U.S., it's just saying nothing of the world. If it's growing at 5% in the industry and you're growing at 5%, we haven't done anything special, even though the world is growing at 2.5. If you're growing at 10, then so, how did you do that? What did you do differently? And that's the kinds of things we're always asking sponsors to kind of audit through and try to understand what they're doing. Then the last piece, which is fundamental to buyouts, is how much did leverage help you? How much did it hurt you? And again, you can look through it. Take out the earnings growth, take out the multiple expansion or contraction, and then say how much is just by the virtue of the fact that you borrowed at a rate of 5% or 10% or 15%, but you were compounding, you're compounding growth at 20%. Your arbitrage, and that's core to buyouts, is you just capture that. Just becomes equity value, because the debt is relatively fixed in terms of payoffs, and the equity can continue to grow. I think that's always been core to buyouts. That said, we've seen a lot of firms where when interest rates were very low, it was obvious. You're borrowing literally at 5% or something, and there's certainly an expectation in the public market that you're going to beat 5%. So in the private market as well, money's just dropping to the bottom line by virtue of how cheap you can borrow. That's not true anymore. Interest rates are significantly up. We've started to see the buyout firms that when that sort of free money goes away, a big piece of their value add also disappeared because their ability to buy right is kind of a question, and their ability to enhance earnings beyond the industry's generalized rate of growth is in question. And what else do you have left? So I think the groups that have done this for decades have demonstrated the ability generally to do it across all those measures, and not necessarily at any given time they're doing all three all at once, but they're also able to identify some companies are going to be easier to lever up, some companies are going to be easier to grow, and some companies are easier to buy because no one else wants them because something's particularly wrong. But hey, and we can fix it and we know what we're doing. It doesn't necessarily apply to every company they've ever touched, but that's also the last piece is a firm that's successful, but then you go through and look at there are individual companies that were not. It's like, what went wrong? The firms that can articulate, we did something wrong. Here's what happened. Here's how we're going to correct it for the future are useful. The ones who blame circumstances, once upon a time, financial crisis, not our fault. More recently, COVID, not our fault. That's not a useful explanation. It's what actually happened. How did you deal with it? It doesn't matter that it failed. It's if this happened again, what would you do? Because by the way, the next crisis, whatever it is not going to be the same as the prior one. So we want to see that level of flexibility and adapting to circumstances.
Absolutely. Amazing insights there. And now let's talk about portfolio construction. So how do private equity firms typically think about portfolio construction? Do you have separate buckets that, okay, we're going to put different deals into all these buckets and that makes a good portfolio? So give us an insight into that.
Yeah, I'd say for us as a ultimately fund of funds manager, we're trying to create a portfolio that's highly diversified. Our investors, I'd say beyond us, are generally looking, if they're trying to get a return greater than the public market, it's a question of what indices are they using as their comparison, and then how diversified are they? Because our view is if the public markets are 20% healthcare, we should probably be in a similar bucket of healthcare exposure. And then you can look down into subsectors. If they're 10% financial services, we should be in the same range. Because if you don't, and you have one thing we've seen in leveraged buyouts in the last 5 years, maybe a little bit longer, is information technology, particularly software, has been vastly overweighted. It became, by our measure, 35% of the buyout space in the last 5 years, which is way more than the public market. And there's good or bad arguments for why you should or shouldn't do that. But it's a lot harder if you have 35% tech and you're comparing to the Russell 2000, which is, I don't know, is 20%. It's like, well, how much of your value is from being private and how much is the fact that you overweighted? Because if you overweighted tech in the Russell 2000, would you get the same return? These are questions that investors ask us. So our view is we should be diversified in a similar way to the public market, but with an emphasis on companies that are appropriate for leveraged buyout space. So I mentioned software companies. There's plenty that are very cash flow positive. You can lever them. We're not going to overemphasize companies that are not good for leveraged buyouts. So we don't do much in venture capital because those are companies that generally have negative cash flow. You can't lever them. They're a different strategy. They don't fit into our mix. Sure enough, the Russell 2000, even the S&P 500 has some unprofitable high growth companies in it. So our view is a little bit of those are not public markets are not an exact proxy for what we're doing. And it's the question of what do we include? What do we exclude? We lean into industries that are more cash flow positive, and that tends to be healthcare, consumer, manufacturing, and industrial, and then some areas of tech, some areas of telecom, but not all of them. There's a lot of work that we do trying to tell our investors and articulate what our portfolio construction is. At the end of the day, it's very diversified on purpose. We talk to a lot of leveraged buyout sponsors that will articulate they're going to be diversified or they're going to be highly concentrated. To us, it's really a question of not do one or the other, but tell us what your plan is, and then do you follow through on that? Some diversify because they don't want too much exposure to one segment. But even then, what we've seen is you could accidentally over-index to something, not actually thinking about it. Use an example. We had a sponsor a bunch of years ago who had multiple companies that were all on the seemed to be different in terms of consumer-facing, industrial, technology, even an element of healthcare, but it turned out they're all almost indexed to Boeing's 787, which at the time was a brand new plane, because they had contract manufacturers straight to Boeing. Well, that's obvious. But then they had stuff indexed basically to long-term, long-haul flights, which were heavily going to be based on the introduction of the Dreamliner. They had companies that were doing healthcare where the big client was Boeing. And it's like you go on, and this looks like they accidentally indexed their entire portfolio, even those across industries, to one publicly traded company. And the other day it worked out fine. Boeing was in a different state than it is today. This was a bunch of years ago. But that's something else we look for, is the unexpected tying together of things that I think even that sponsor didn't really think through, because at the end of the day, if the Dreamliner had been a disaster, so would their fund would have been as well. I think it all worked out fine. But you're always looking for the through lines to figure out, did you accidentally invest in a correlated fashion, even though you think you have a diversified portfolio?
Right. Yeah, that's very interesting to learn. And coming to my last main question before we go for the wrap, and this, since you're looking at global private equity deals, secondary transactions and all, and you have teams spread across the world, do you use different lenses to evaluate deals in different regions, or does that remain same more or less, regardless of where the deal is coming from, what region it is from?
Yeah, our view is at the outset, every company has the same dynamics, again, operational, financial, that you can review. You need to compare them against their peers, but it's the peer comparison where you start seeing differences. So in some industries, I'd say to generalize, in a lot of industrial applications, in technology applications, it doesn't matter where in the world these things are happening. It's the same global customer base. So are your costs cheaper than somewhere else? How much does it take to deliver your product? It doesn't matter; they're all the same. So I don't care that you're the best software business in your country. You're competing in the global marketplace. It doesn't matter anymore. It's how do you compare against the global market. There are differences though in highly regulated industries, or ones that are very localized. So if you're in healthcare, every market is every country. You look at the EU. There's different policies on healthcare in every single country, in terms of what they're allowed to do, what kind of margins they're allowed to have. You go to the US, it's another different set. So that's where you start having to adjust for the localized market. The same thing is true if you're doing something that's physically very heavy or a very localized service that can't be spread elsewhere. Then it becomes a question about the local market and how dynamic is it. And that's where we start seeing differences. I'd say the most obvious example is localized consumer services, restaurants or otherwise. There's big differences between how those kinds of identical restaurant in the US versus Europe versus Asia, growth rates are different, consumption patterns are different. So even though it can be the same company, and large publicly traded global companies, McDonald's being a prime example, has articulated for many years the difference of how they operate in the US versus each country in Europe versus China versus Japan. They've had success in all those markets. That's how we look at private companies. You start having to figure out how would they tweak the business if they're in something that needs to be individualized for a market versus it can go anywhere. And that's pretty important for us.
Absolutely. Thanks for sharing that. And to close this out, do you have any book recommendation, course recommendation, video recommendation for our audience who would like to learn more about how private equity works and how different things move here?
Yeah, there's only one book I recommend, which is dated, and it's the one we ask all of our incoming analysts and interns to read, which is a book called Barbarians at the Gate, which was written by two Wall Street Journal reporters roughly in the very early 90s, and it profiles the fight for RJR Nabisco. Once upon a time, it was the most famous buyout case. It was the largest buyout in the world, publicly traded company. And there was a fight among the handful of small buyout firms. Spoiler, KKR wound up winning it. But it's the story of how different buyout firms decide they want to own this. Some of whom have the original idea, some of whom wanted to work with management, others who don't. What's actually in the business, because it had cigarettes, which is even back then was problematic, and then lots of Nabisco and cookies. But then the cookie factories were kind of crumbling. It's like, what are you actually buying? Others who hear about it and like, well, I want to bid too. And then the run up, but then it also just showed how the investment bankers are trying to find a dance partner. If I can just find someone to bid, maybe I can get the business. Lawyers, that whole ecosystem still exists. Many of the players, in fact, are still around. Some have retired or otherwise. But I would say Barbarians at the Gate is the one book that tells you how buyouts are done. Not the execution per se, but the fight for why would someone want to own this business and what are their plans? And then how do they magically change their plans because they have to pay a higher price. They have to justify the higher price. They're going to do something extra and more magical and special. That's the book I think best lays out in a very interesting and kind of a thriller type page turner way.
Awesome. Thanks for that recommendation. And now let's do the rapid fire round where I'll ask you 5 quick questions about the investing you're doing. And you have to give 5 quick answers, right?
Surely, yeah.
So the first one is, what are the sectors and regions you invest in?
We invest across sectors and around the world, from developed markets into emerging markets, and we've even done work in frontier markets. So our view is it just goes back to the fundamentals of valuation, trying to find investments that we think are properly valued and have good prospects.
Awesome. What's the typical stage when you become interested?
For us, it's when the business is cash flow positive. It is critical for us because that starts sustaining the ability to you limit how much new money you have to put in the business, and then it also introduces the possibility of borrowing against that cash flow.
Absolutely. What's the typical check size per transaction?
We have, as I mentioned, PineBridge is global asset manager, about 150 billion of AUM. My team has done deals as small as $10 million in size, and then gone up. The biggest transaction, which is a portfolio of many funds with literally thousands of companies, was over $2 billion in size. So we've had a lot of flexibility in how we deploy our capital.
Awesome. Where can our listeners go and follow you and what PineBridge is doing?
Well, PineBridge Investments, we're in a variety of social media. Speaking for myself, I'm not, I still hold to the idea that private equity is still very private. So a lot of my conversations wind up being one-off, which is great. As a firm, we do put out content, some of which I've written across social media.
That's awesome. It's good to have you here today so that you can be a little public and share the amazing insights that you have. And the last one, where can our listeners follow you? Do you have LinkedIn or something like that?
I am on LinkedIn. That's the only social media that I utilize. I'm always happy to hear from new people. And at the end of the day, this is still a relationship-driven business, and it's great to talk to people who have different ideas and different interests. And that's been very productive for my team for a long time.
Awesome. So this has been the longest VC10X podcast till date. I think we've done over 160. So that speaks for something, and I think it's totally worth it. Thanks so much for making time for this, Justin, and I wish you happy investing.